Okay, so welcome to our recorded lecture all about assertions. Now, when you talk about assertion, these are the representations that the management usually provide to the third party, to the shareholders, lenders, or bankers. That is part of the financial statements. So, in this case, whatever the financial statements will contain, it is classified as assertion. Okay, so this is important because they are trying to send message to other parties. So, for example, they will mention that they have cash at bank. So they are asserting that they have cash at bank. Or let us say they have a payable, okay, to maybe a supplier or a bank. So as an auditor, what we do is to test whether those assertions or the representations made by management does really exist or in the right value or accurately calculated. And as an auditor, we have to design procedures to test those assertions. So we have two categories of assertions. We have account balances and related disclosure and for transactions. So when you talk about assertions related to disclosure for a particular period under audit, we are talking about income statement accounts. While those assertions about account balances and related disclosures at the period end, we are talking about balance sheet accounts. So for assertions about classes of transactions and events and related disclosures for the period under audit, we have these assertions. We have occurrence, completeness, accuracy, cutoff, classification, and presentation. So again, the focus will be on the account which is under income statement. So when you talk about occurrence, talks about whether the transaction which related to the account really happened. And with regards to completeness, whether those transactions that should have been recorded in the books of accounts had been recorded. So they're trying, the management is saying we already had accounted for all the transaction and recorded it in the journal book and posted in the ledger. While accuracy talks about whether the transaction had been recorded appropriately, of course, based on the amount which represents in their invoice or maybe in other documents. Cutoff, on the other hand, is making sure that all transactions belongs to the correct accounting period. While classifications or classification which is pertaining to whether the accounts are been properly classified, whether it will be sales or administrative expenses or a borrowing cost or finance cost. While presentation is focusing on how it will be presented in the financial statements. Do they need to aggregate it or disaggregate, separate it in the presentation, and what are the disclosures needed? Now, when we talk about assertions about account balances, related disclosures, and or at the period end, it's focusing on the balance sheet accounts. So the first one is existence. That's basically pertaining to assets and even liabilities and other equity interests. Rights and obligations, completeness, accuracy, valuation and allocation, classification, and presentation. Now, in existence, of course, that's a basic one. We have to just, as an auditor, we can see or we will try to see whether the item really exists. If the management had mentioned that it's with them. While rights and obligation, we are trying to determine whether the company has their existing right or have existing right towards assets, or are they uh, sort of obliged to pay something? So this is pertaining to the liability. Completeness, same with the income statement accounts, but here our focus, of course, will be on assets, liabilities, and equity interest. So, as an example, let us say receivables. Okay, so all credit sales had been recorded or outstanding amount recorded collectible to a customer had been recorded, okay, or had been accounted for. And then when you talk about accuracy, valuation, and allocation, again based on the calculation and records. When you talk about valuation, it's much related on estimates like percentage uh, of sales, doubtful accounts, or aging of receivables. Allocation, on the other hand, is related to depreciation. Okay, so straight line method or systematic approach in depreciating an asset. Classification, uh, again, determining whether you have to classify it on proper category. Okay, for example, if we are trying to figure out whether to classify the asset to a current or non-current asset, so that is important when you're presenting a financial statements. When you talk about presentation, same. Are we supposed to aggregate those accounts or disaggregate an account, or how we will disclose the item? So let us have an example, two examples here. We have for income statement account and later on with balance sheet account. So first question or the first thing that we will have is as income statement account. Well, let's focus on sales. So first question is, does the company recorded all the sales which had been transacted during the financial year? So that's a question. So we have to figure out what is the assertion, okay, in this case. So here we are trying to figure out if it is representing completeness assertion. The second one is, did the billings and invoicing section charge the correct amount to the sales invoice? So it talks about calculation, amounts, and value. So that will be accuracy. And then the third one, do all the sales transactions recorded uh, during the financial year happened? So we want to figure out whether those sales which included in the ledger of or sales ledger of the company really happened. Okay, so we are testing the assertion occurrence. Then for balance sheet account, okay, so let's talk about fixed asset account. Okay, so first question that we can ask is, do all fixed assets included in the fixed asset register exist? So we want to test the existence of those assets. Then second question, do all fixed assets acquired recorded at the appropriate amount? So again, value calculation and recording of the correct amount, that is focusing on accuracy, valuation, and allocation. So just to point it out here, now when we talk about fixed asset, it's not only the acquisition price, you also have to look into the subsequent measurement of the account, whether they're using cost model or revaluation model. Okay, but then again, it is only focusing on the assertion, accuracy, valuation, and allocation. And then on the last question that we want to ask, does the company hold the right to use a particular fixed asset? So we are trying to test rights and obligation. So that's it for my recorded lecture. Thank you for watching. Hope you learned something.